Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Recently, I was going through the financials of a decorated PSU company and I couldn't help but notice how Mr. Market has been very generous in its valuation of the company. Now, let us learn about this company through an interesting case study. Here's the financial of two PSU companies. Now, you have to tell me which one deserves to be treated better by the investors. Here's the P&L statement of the first one. Now, this PSU has more than doubled its top line in the last 10 years, and same for the bottom line. Although the performance is stable, the growth is not very impressive. Over 10 years, the top line and bottom line should have at least quadrupled, but instead, they've only doubled. Here's the balance sheet of the same PSU. The company has a bit of a debt problem. Its debt to equity has consistently been higher than an acceptable level of 1 times. Otherwise, the growth in balance sheet has been steady. It appears that the company makes its capital allocation quite judiciously and is not in a hurry to grow. So the balance sheet is certainly leveraged, but there is stability about it as well. Now let us move to the second PSU. Well, if the performance of the first PSU, which doubled its top line and bottom line in 10 years, was disappointing, this is even more so. This PSU has grown its top line by only 50% over 10 years, while its bottom line has grown by a little over 20%. However, like the first PSU, the performance has been largely stable. When it comes to the winner, the first PSU seems to have a definite edge in this round. Let us move on to the balance sheet of the second PSU. Here, the balance sheet has not grown as fast as the first PSU, with the total size increasing by 50% from rupees 10,000 crores to rupees 15,000 crores. The good thing about this PSU is that it's a zero debt company. Unlike the first company that was leveraged, the second PSU's debt has consistently been almost zero, which is certainly a good sign. Hence, when it comes to the balance sheet, it is this PSU that has the edge, in my view. Now, let us talk about how their ROEs or return on equity has moved over the last 10 years. Here, both the PSUs have shown remarkable consistency in their ROEs. It is the first PSU, however, that has a slight edge over the second. All its ROEs, that is 10-year, 5-year, 3-year, and even latest, higher than the second PSU. So here's the summary. While both the PSUs have shown stable performance over the years based on numbers alone, it is the first PSU that has a slight edge over the second one, in my opinion. Its growth was better and its return on equity was better. The only area where it lagged was the balance sheet. It had significantly higher debt relative to its equity as compared to the second PSU, which is virtually a debt free company. So maybe PSU 1 has an edge, or maybe it does not. However, here's the interesting bit. Investors in the stock market have always valued the second PSU significantly higher than the first PSU. Yes, that's right. A PSU that has grown slower than the first one and which had lower ROEs has enjoyed a much superior rating by the investors. Over the last 10 years, investors have given the second PSU a P multiple of more than 30 times, whereas the P multiple given to the first one has been a little over 10x. It is the same situation when it comes to the price to book value multiple. The second PSU has commanded a price to book value multiple that's almost 3 times the price to book value multiple of PSU 1. The story is quite similar from a 5-year perspective as well. In short, investors have always put PSU 2 on a much higher pedestal than PSU 1. But why is this the case? Why PSU 1 hasn't earned the same respect as PSU 2 despite having better growth and better return on equity historically? Well, to be honest, I don't have a clear answer to this, but I'll make an attempt anyway. But before I do that, let me reveal the names of the two stocks for you. PSU 1 is none other than National Thermal Power Corporation, or NTPC as it is popularly known as. PSU 2, on the other hand, is Container Corporation of India, or CONCOR as it is popularly known as? Yes, Container Corporation has enjoyed a significantly higher P multiple as well as price to book value multiple over NTPC historically. When you think about the business model of these companies and about the industries to which they belong, it does appear sensible that Container Corporation should be valued significantly higher than NTPC. After all, power is a regulated sector with high capital intensity and limited growth prospects. But despite Container Corporation's superior business model, it is not reflected in the numbers as yet. Its growth has lagged that of NTPC, and its return ratios are also at par or slightly below NTPC's. Then why is it that investors have been willing to pay a significant premium to buy shares of Container Corporation as compared to NTPC? I'm sure you would have heard of the famous book by Jim Collins titled Good to Great. Now, Good to Great had achieved a cult status back when I was doing my MBA, and management students were often seen walking around with a copy of the book in their hands. This book had a byline which went something like this: Good to Great, why some companies make the leap and others don't. Well, investors are hoping the exact same thing with Container Corporation of India, CONCOR Limited. The reason it is getting significantly higher valuations as compared to NTPC is that the company is expected to make a leap from good to great. Now, there's no doubt that NTPC is a good company, but can it become a great company? Looks unlikely given the sector it belongs to and the regulatory oversight it finds itself under. However, investors believe that CONCOR is certainly capable of taking that leap from good to great. Now, India dreams of becoming a developed nation by 2047. And if this dream has to turn into a reality, both our manufacturing as well as our exports have to step up. Without a robust manufacturing as well as exports setup, it will be very difficult for us to achieve a developed status. And if manufacturing picks up, more goods will have to be transported through CONCOR's containers, its wagons, and its rakes. More freight stations as well as container depots will have to be built, thus giving a big boost to both the top line as well as the bottom line growth of CONCOR. Now, it is the possibility of this growth that is pulling investors towards CONCOR and making them pay a significant premium over its peers like NTPC. Do you believe this dream of ours will turn into a reality, making CONCOR one of the leading beneficiaries? If yes, then CONCOR certainly makes for a good long-term bet. However, if you think that the competition in the sector is going to intensify and CONCOR would continue to wallow in mediocrity like it has done in the past, then a caution is certainly warranted. You'll have to make up your mind fast, as the opportunity of riding the manufacturing growth story through a stable and a strong business like CONCOR may not last long. Let me know what you think. This brings me to the end of today's video. I'll see you again next time. Goodbye and happy investing.